You just visited a bunch of regionals, right? You went to Capital One. You talked to the CEOs of all these banks. Capital One, Key Corp, First Horizon. What did you find out from these regionals?
I found out that the regulatory environment is really tough, tougher than I would have thought before the visit. I'd also found out that loan demand is coming back, which is good. Pricing is very competitive, and they all want to acquire. Every one of the companies that I met with is seeking to try to acquire.
They want to get bigger, though, despite the regulation?
Yes.
Okay, but you noted, though, that there's this sort of $10 billion level here that they're struggling with, right?
Right.
Describe that. What does that mean?
Well, all these banks are over $10 billion, and at $10 billion, the Durbin Amendment kicks in, which means you make less money because of interchange limits. So the banks
they can't charge as much because of the Durbin Amendment, right?
Right.
Okay.
So the banks that are approaching that $10 billion level, they have an interesting decision to make, because if they go $1 over $10 billion, excuse me, they have to go to like $12.5 billion.
This is $10 billion in market cap or $10 billion in revenue?
$10 billion in assets.
Oh, excuse me, assets. Okay, couldn't be $10 billion in revenue. What am I talking about here? Okay, so basically what they're saying is that they don't know whether or not the smaller banks that are growing, whether they want to get above this $10 billion in asset mark, because they feel that if they do, they may not be able to grow as fast.
I think yes, because their revenues will come down because of the Durbin Amendment. So I think you're going to see a number of banks get to the $9 to $10 billion category, and then they may choose to sell the company.
But why aren't we seeing the selling then?
Well, if prices of the acquirers are going down, we're not going to see massive consolidation. So what we need is what happened yesterday. We need prices to go up. And then I also think by the end of this year, as banks look into the 2013 and they see it's going to be a tough revenue growth environment for them because of low interest rates,
right,
that many of them will decide to sell at that point.
So what you're saying is that with a declining stock market, they don't want to see these stock prices continue to go down because it makes them less and less attractive, and so you're not going to see this type of consolidation going on in the banking sector then.
Well, yeah, the gap between what the sellers want in terms of price and what the buyers can pay, when the currency value, which is the stock price of the buyers, goes down, that gap becomes so big that we can't get a transaction.
But you also observed something else in your discussions, right? Which is what you said is that consolidation is probably more likely if you've got an older CEO at the helm of one of these banks than somebody who is a young guy like you running a bank and may not want to sell out. Why is that? What's the difference there?
Well, yeah, one of the differences between this cycle and the early 90s cycle is we turned over so many CEOs in the Great Recession. So we have a bunch of 50-year-old CEOs. Well, they haven't accumulated enough wealth in terms of stock of their company that if they got a 30 or 40% premium by selling it, they wouldn't make enough money. Back in the 90s, we had CEOs who made an absolute fortune because they had accumulated stock, we'd had a bull market in equities, and so they could sell out and retire. You can't do that today. So what we need today is to identify targets where the CEO is between 60 and 65, and those are the likely targets.
Who've made their money, are likely sitting on a pile of fortune and don't mind then to sell out.
Exactly.
And who are they? Have you identified these targets, Tom?
We look to identify them, but then sometimes, in fact, there's West Coast Bank is a very likely target.
Okay.
But the market has recognized that so well that I don't think that if they did sell, there'd be a large premium to where the stock is trading at today. You know,
we talked about U.S. Bancorp. I wanted to get your opinion on this yesterday, and Richard Davis is CEO, who I think sits on your board, right? And we talked about the fact that he brags that his bank is a very boring bank, and in fact is more attractive because of that. That stock is up, I think, 9%, probably more after yesterday's rally. And this is something that you've heard echoed among these CEOs as well, these other regional banks.
We just did an analysis of the top 50 banks. And we said, okay, which is the best position to grow over the next 5 years? Not which is the most attractive investment, which is the best position to go. And there are three names that stood out. U.S. Bank being one, Capital One being the second, and Wells Fargo. They look to us to be the best position of the top 50.
Okay. For the big Wall Street firms, though, and particularly after the hearing that you saw with J.P. Morgan yesterday and the continuing ones going forward, does that signal for you, Tom, that these too big to fail are eventually going to have to break up or get smaller because of this sort of tightening regulation in Washington and all this scrutiny?
Well, it's interesting. I've had a bunch of discussions with these top four banks recently, and I will say at two of them, B of A and Citi, they are shrinking. So we're not going to go through a massive breakup like we might have seen, but there's no question that there's pressure on these companies to get smaller. B of A has already announced what, some areas that they're definitely pulling
They're
back.
one of the big banks that is actually getting smaller.
Right.
Which is interesting. But I mean, are there eventually going to be others that fall in line with that, do you think?
I don't think of these four. I think right now we're still going to see Wells grow, and we're not going to see JP Morgan shrink. However, the other two, there is pressure for them to simplify their organizations.